What are investments, why it is needed, who invests the money, and what are its merits, and what kind of analysis are made. So let's proceed with the meaning first. Investment is an activity that is engaged in by people who have savings. That is, investments are made from savings, or in the other words, people invest their savings, but all savers are not investors. Investment is an activity which is different from saving. Yes, it is absolutely true. That means investment is only made by those people who are having surplus funds or excess money, what we can say it. Okay, the person who is having surplus money, in order to generate more revenue from that surplus money or the excess money, he invests in the various avenues by sacrificing the present value of that money, so that he can gain more money in future with the higher rate of return by adapting the risks. Now, all investment in an investment is a monetary asset that is purchased with the idea that asset will provide income in future, will later be sold at a higher price for a profit. Yes, being an investor, absolutely, as I said, that investment is only made by the person who is having surplus funds, right? Only the person who is having surplus of funds, he makes any investment. So either he can purchase any asset, that may be a land or building or any shares or bonds, that means which will generate a higher profit in the future date. For example, if you purchase a land now, if you Mr. X has purchased a land, so now the land value is say for example it is for 8 lakhs or 10 lakhs. Let us consider as 10 lakhs. So in the next, after 2 years, the land value, the land which is purchased by Mr. X will be more than that the value, right? That means he can sell it for the higher prices, because obviously the value goes on increasing, right? In such way, whenever an investment is made by the investor, that is he who seeks future profit, that is higher profit rather than what he purchased, so that he can generate excess profit from it. Coming to the definition, or focusing on the definition. So F. Amling, he defines that a purchase of financial asset that produces yield that is proportionate to the risk assumed over some future investment period. That means, so when you invest something, there are certain risk, there are certain return. So it is a proportionate income which is generated by taking the risk over a period of time. That is what investment is. So according to Sharpe, he defines that investment is a sacrifice of certain present value for uncertain future values. As I said, right, as I gave in the example of land of Mr. X, that means if he purchases at present, if he purchases for 10 lakhs, later in future he can sell it for 30 lakhs or 40 lakhs or 50 lakhs. That means he is going to sacrifice the 10 lakhs present value of 10 lakhs in order to gain the higher profits in the future. This is what the investment means according to Sharpe and F. Amling. So now let's discuss what are the objectives of investment, why it is, well, then what you gain from the objectives, what is the main motto of investment. That means first and foremost objectives, income, right? So the surplus money holder or the excess money holder, what he does, he invests so that he can generate extra income from that particular investment, so that whatever the money invested by the investor in any of the avenues it may be, so that it should generate certain income rather than having some dead investment, so that it should gain some income. Next, coming to capital appreciation, as I said, so capital appreciation is only possible in case of, second objective is capital appreciation. See, capital appreciation. So being an investor, obviously your main motto is to increase your capital what you have invested, right? So you expect a return from whatever the capital you have invested in the investment. So either it may be land or building or any equity or any kind of avenue wherever you have invested the money. So you seek growth in that investment, right? So that is what capital appreciation is all about. Either it may be conservative growth or it may be aggressive growth. Sometimes conservative growth happens. That means who seek to build more investments, those are termed as conservative growth. So that is for long term. So conservative growth is for long term. The person who wants to survive for a longer period of time and invest the money in the investment, that is known as conservative growth over a period of time. And whereas in case of aggressive growth, the person who want gains, who want return on investments in a very short period of time with a higher return, only within short period of time, and he expects more return. So that is known as aggressive growth. Next, forms of return. So forms of return. So when you invest something, you will get a periodic receipts, right? Just like as we when we deposit money in savings bank account, we get interest for 6 months. So in the same way, so when you are going to invest the money in any kinds of or any avenue of investment, any avenues, various avenues of investment, so you expect a forms of return, right? So for that return only you are going to invest. For that is the reason you are going to sacrifice the present value in order to gain the future benefits. So forms of return, either it may be periodic cash receipts, capital gains, right? Periodic cash receipts, either you can get receipts on the basis of quarterly, half yearly or yearly, right? Just like bank fixed deposits. So fixed deposits, you invest certain sum of money on so and so date. After a year you will get a money along with your principal amount, you will get a certain interest, that is for your at the end of the year, let's say 1 year, right? In the same way, in the second component of the capital gains, that means when there is a changes in any component of the investment, either it may be price, risk or time period, at that time what happens, the return varies, right? This differences between the purchase price and the selling price is treated as capital gain. For example, as I said, as I have given in the case of land of Mr. X, right? If he purchases for 10 lakhs and if he sells for 50 lakhs, that means the difference between periodic statement, that means when he purchased it for 10 lakhs and now he is selling for 50 or 60 lakhs, that means the difference between the initial price and the selling price, purchase price and the selling price, that is treated as forms of return. Either it may be periodic cash receipts or capital gain. Next, coming to the fourth objective, that is safety and security of funds. So which is one of the foremost thing, right? Main objective or the core objective. So you want some safety or security so that your fund can generate a income over there in the other forms of securities. So here you seek risk and then you invest, because when you are going to invest in some of the avenues, either it may be equity, bonds or mutual funds or gold, any other avenues, so there you are going to take the risk and you are going to invest the money. So there you have safety as well as security of the funds, so that you are going to generate over a period of time. You are going to generate an income over a period of time. Next, coming to the risk. So risk plays a very prominent role here, because without risk you are not going to get the return. So whenever an investor is going to invest in any of the avenues, he should be ready to tackle the risk. Either he should be risk seeker or risk averse. So he need to bear the risk in order to get the return on investment. So now coming to the one more objective, liquidity. Here the term liquidity means which can be easily convertible into cash or cash equivalents. So whenever you want money or whenever you want to withdraw the money from your investment, so which can be easily convertible into cash or equivalent to cash value. So that is termed as liquidity. Next, coming to the last objective, that is tax considerations. So whenever you make certain investments, so you can get exemptions from the tax, so that you can evade the taxes, right? So that's how you are going to you can reduce payment of taxes. So that's how investment plays a very prominent role. If you invest in some of the securities, so that you will get some tax consideration, so that you can pay less taxes when compared to previous year taxes paid by the you people. Coming to the most essential things, that is elements of investments. So these are the 5 elements which plays a very prominent role, that is risk, return, time, liquidity and tax savings. So as I said in the objective, risk, so the person who seeks the risk, he or she should only invest in the investments. If you are not ready to take the risk, then it is of no use. Return, so how you take the risk, in that way only you will get the return. Higher the risk, higher the return. Lower the risk, lower the return. Next, coming to the third element, that is time factor, short run as well as long run. long run, right? If you are taking risk for short period of time, more risk is required, right? More risk is required in case of short term, and you are going to invest, then you will be having greater return. Whereas in case of long term, you will be gradually, your income will be increasing over a period of time. Next, coming to the liquidity, as I said, liquidity which can be easily converted into cash or cash equivalents, so that which can be helpful for you to easily convertible into cash or cash equivalents. That means you can withdraw the securities or withdraw the investments to the near money value, near market value. Next element is tax saving. So as I said, tax considerations, as I said, right, one of the objective. So in the same way, it is one of the elements so that you can evade the taxes, so you can pay less taxes by investing in the various avenues. So these are the elements of investments. Coming to the avenues of investment, as I said, right, being an investor, you can invest in n number of securities or n number of investments. So let us discuss what kind of avenues are available for the investor, so that where he can invest his money. First and foremost thing is bank savings or FD. As I said, everyone having savings bank account, right? So everybody who deposits money in his savings bank and earns the interest over a period of time, right? In a year we get 2 times interest, whereas in case of FD we get annually, right? So where you are generating income periodically, either half yearly or yearly, where you are going to generate your income. So next, coming to bonds and debentures, investing in bonds, debentures like government securities. So you are going to invest and you are getting the return on those things. Next, coming to mutual funds. So mutual funds is a venture, it is high risk funds. So where you want to take more risk and where it is highest risk bearing factor. So it is having greater return over a period of time. Next avenue is equity. So each and everyone know about equity, right? So where you can trading in equity. So before you are going to trade in equity, you need demat account, which stands for dematerialization account. So where you can, through the help of demat account, you can trade the shares, you can buy and sell the shares. Next, coming to the commodity. So commodity, the term itself says where you are investing in coffee, tea, or any commodity, either it may be gold, silver, platinum, anything, it may be trading in that particular commodity, so which is having some greater return. Next, coming to real estate. So real estate, the person who is engaged in sale of land or any villa like that, you are going to generate a income. So I think no need to say about gold, as gold is already included in commodity market. Next, small government investment schemes. That means investing in government bonds or investment schemes such as like government investment schemes such as like Sukanya Samriddhi Yojana or National Pension Scheme, Public Provident Fund, National Savings Certificate, Atal Pension Yojana, Pradhan Mantri Jan Dhan Yojana. See, these are the various kinds of government investment schemes where you can invest and you can gain a greater return. Next, coming to the next term is speculation. So speculation plays a very prominent role. So in general, if we want to say, we can say it as a gambling or insider trading in technical terms. So speculation refers to the act of conducting financial transactions that has substantial risk of losing the value, but also holds the expectation of a significant gain. I think, for example, just like how the big bull, right, the scam of 1992, we can see that, we can say the example of it, because when the insider information is leaked out, so where you can gain a more value, right? In the same way, you will be having certain financial information, so in that you are bearing a greater risk. Depending on that, you are going to invest and then you are going to get a greater return. So without the perspective of substantial gains, there would be a little motivation to engage the speculation. So that means it completely depends upon the nature of the asset in which you are going to invest. If you are going to invest in shares or equity or debentures, then you should take more risk, because it involves high volatility of risks, right? Because the share value keeps on changing, and sometimes you may gain more profit, or sometimes you can become insolvent also. Next, as we have discussed about speculation and investment, so now let us discuss about some similarities or the differences between the investment and speculation. So as I said, the purchase of an asset with the hope of getting returns is called investment, but whereas speculation refers to it is an act of conducting risky financial transaction. That means where you are involving yourself in order to get more profit. So you are risk seekers. Speculators are always a risk seekers who want to take the risk and get maximum returns. So investment refers to the acquisition of asset in the expectation of generating income, but whereas in case of speculation, it is a trading activity that involves risk of financial transactions. That means enormous profit. You can make enormous profit as well as you can gain enormous loss also. Next, so investment is made for longer term, whereas speculation is made for short term. So in investment, you will be having moderate risk, not that much higher, but you will be having moderate risk. But whereas in case of speculation, you will be having very high risk and higher return. So in case of investment, what happens? There is a change in the value of an asset or the avenues of investment. Either, as I said, either it may be land, building, gold, commodity, or any other investment schemes. So there is a change in the value, but whereas in case of speculation, it is only possible in case of tradable securities such as equity, debentures, bonds, because here the changes happens in the prices, not the value. Changes happens in the prices. In case of investment, you will be having modest rate of return, but whereas in case of speculation, you will be having highest rate of return. So what happens in case of investment? Investor uses his own funds. That means the person who is having surplus money, he invests in order to get more profit. But whereas in case of speculation, speculators borrow funds and then they invest. So investment is done by the investor, speculation is done by the speculator. That means here what happens? Here the market is stable, whereas in case of investment, but whereas in case of speculation, here it is uncertain and erratic. So in case of investor, he is very much conservative and cautious. His nature will be very much conservative and cautious. But whereas in case of speculation, the speculators are very much daring and careless. They are ready to take the risk. They are not bothered about it. They are not even bothered about anyone. So they want their return on investment in a short period of time, and that to a greater extent. But whereas in case of investment, he is very much conservative and cautious, and he is very much patientful. He will wait for the longer period of time in order to gain the profit. Sources or types of financial information. Yes, this is one of the foremost thing for an investor when he or she wants to invest in any one of the companies. That means he want to rectify the company's income statement, whether the company or the organization is making very good income or not over a period of time, because by analyzing income statement, the investor gets a clear picture idea whether to invest or not to invest, whether the company is in favorable position or unfavorable position. So now in the same way, balance sheet also. So the next financial information which is used by the investor is balance sheet, whether the company is running in loss or not, whether the company's balance sheet is true or not. Okay, next, third type of financial information is cash flow statement. That means how the organization is spending their cash. That means how they are generating the cash and how they are spending it. That is what for most thing important for any investor, because if the organization, whether the cash inflow is very less and the outflow is more, then the person is not going to invest in that company. A person invests in only that company where they have more inflow and less outflow. That means they should generate more cash inflows, right? How the process of investment begins. So this is one of the foremost important thing. The first process in the process of investment is setting the investment objective. It is the first and foremost and the basic objective. Okay, it is the first process for any investment. So is it being an investor, what your main objective is? So for example, whether to optimize the rate of return or to maximize the rate of return. So this is the main objective or the core objective which the investor has to set. So now coming to second process, that is establishing the investment policy. That means how you are going to allocate your investment amount amongst all the other major assets which are present in the market, and how you are going to allocate them in the capital market. Either it may be because there are n number of avenues, right, such as equities, debt, fixed income securities, real estate, foreign securities such as foreign currencies, trading in foreign currencies. So you need to have a proper investment policy in which you want to invest. So next, coming to third process, that is selecting the portfolio strategy. See, the portfolio strategy selected, the portfolio strategy selected should be in accordance with your comfort, but conformity with the investment objective. That means whether if you want to maximize, then you should invest your securities only in maximizing the return or optimizing the return. So the first step and third process should be interlinked. Third step should be accordance with the first step. Next, coming to the fourth process or the fourth step, that is selecting the assets. The assets to be placed in the portfolio. Portfolio means it is nothing but the bundle of securities in which you want to invest. That means bundle of securities where the investor wants to invest. So this point where real creation of portfolio will take place after the selection of assets. That means, for example, if you select gold, so whether you want to invest in gold bonds or gold biscuits or some other thing, etc., like this, so in which you want to invest, that means it completely depends upon the establishment of your investment. Next, after selecting, how you are going to measure the evaluation of the performance. In this step, how you will measure your rate of return on your investments. That means on what you have invested, how much you will get your return over a period of time. That means you are measuring the performance of your investment. Okay, so this can be measured by the four techniques or four tools are there where you can measure your rate on return. Okay, that we will discuss later. So now coming to measurement of risk and return, as I said, so each and every investment have their own risk and return, right? So here types of risk, there are two types of risk. One is systematic risk and one is unsystematic risk. So systematic risks are uncontrollable, that means which are macro in nature, which are external, which are affected by the external environment. And whereas in case of unsystematic risk, those are affected by the internal of the organization, which can be controllable. They are micro in nature. So these are the various types of risk. In case of unsystematic, interest rate. First and foremost thing is interest rate. Sorry, in case of systematic risk. In case of systematic risk, first type of risk is interest rate risk, because interest rate varies over a period of time, right? So in the same way, market risk also. Market risk comprises of various risks: absolute risk, relative risk, directional risk, basis risk, volatility risk. And next come to purchasing power or inflationary risk. That means how the economy is growing, in the country. That means whether you have inflation or deflation, whether the country is having enough purchasing power or not. These are the systematic risks and these are uncontrollable factors. Now coming to unsystematic risk, there are business risk or liquidity risk. That means asset liquidity risk and funding liquidity risk, whether which can be easily convertible into marketable value or not. And financial risk, that means how, because financial crisis plays a very prominent role, right? Because when you don't have any money supply or source of finance, then the company, then the investment goes in a very much big trouble. Next coming to operational risk, that means how we are going to operate, whether it is from the people, legal, political, that is political and legal factors are going to affect the operational risk. Risks are measured, as I said, right, in measuring and evaluating the performance of an investment or the securities. So these are the four measurements through which you are going to measure the risk: alpha, beta, R squared, standard deviation and Sharpe ratio. So for your syllabus, it is alpha, beta, standard deviation and Sharpe ratio, and R squared is not that much important, because in the present trend people follow alpha, beta, standard deviation and Sharpe ratio more. Now coming to beginning of video, I have said that being an investor, he does various analysis. Under that, it is the first one, fundamental analysis. That means it is a logic and systematic approach to estimating the future dividends and the share price, and based on the basic premise of the share price is determined by the number of fundamental factors that is relating to industry, economy and company. So whenever you are going to invest in any of the companies, mainly you study the economy, you study the company, then you study the industry, right? That means where the industry is going, where the company is going, right? and economy, mainly economy. How is economy, whether economy is in favorable position or it is in unfavorable position. So it can be done in three ways. We can say that in fundamental analysis involves three prominent steps, that is economic analysis, industry analysis and company analysis, right? Because these three steps plays a very prominent role where investor need to analyze critically and then he wants to invest. Let's discuss one by one. The term economic analysis, the term itself says where the investor mainly focus on the economy of the country, or the investment depends on the economy of the nation. So here the key elements are gross domestic product, gross national product and net national product and etc. That means where the country is actually in progress, whether the country is having enough GDP rate, GNP rate and NNP rate, because with these factors only the company is going to progress, the economy is going to progress. So that if we invest, then only people buy, then only people are attracted towards the investment, then only you can gain a return on your investments. So it has main four components, right? Economic analysis is mainly based on the economic cycle or the business cycle, what we can say, right? That is, these are the four phases which is covered. That means depression, recovery, boom and recession. So depression, it is a phase where the economy is in utter loss, where you cannot generate any source of income. Okay, depression is a phase where the company or the where the nation is not capable enough to generate any income. Now coming to recovery, there is a slight hope so that the company is recovering from their losses. That means they are capable enough to make the investments, they are capable enough to gain the startups, they are started to attracting the investments. Boom, it is a peak stage where the investments are made in a very high stage. That means investments are at the peak level, the rate of return on these investments are also very high. Recession, where there is a slight fall in the investments. That means where the investors withdraw their money because after certain period of time it starts collapsing, where the mode of investment goes low. So at that time what happens, slightly the investments made in the early stage, that is recovery and the boom stage, might not be there. In recession, slightly the inflow of cash may be very much difficult in case of recession stage. So let us understand. See what happens in case of recovery. That means where you get a gain momentum. That means when you start exposing the things, right? Where you start recovering your stage. So next comes expansion stage. You can see expansion means economic growth. That means where you are going to gain the more expectations. That means a rise in the technology, consumer discretionary. That means where people are getting attracted towards the investments. Peak. Here what happens? Financial, energy, materials are at a very peak level and it is very much high. In case of recession, stock prices are likely to fall. That means due to the entry of competitors and utilities or consumer staples and healthcare. That means what happens, mainly they slightly fall. That means the prices of all the other sectors start falling once it reaches to a very peak level. So this is what economic analysis, being an investor, this is how he make analysis of the country or economy. Now coming to analysis, I think everyone are aware about industry analysis. That means it is very much similar to industry life cycle. That means how the industry is going over a period of time, that is starting from its pioneering stage to decay stage, or we can say from introductory stage to decline stage. Okay, it has four phases, right? Each phase have its own prominent thing. So now let's discuss about it. So industries ultimately invest his money in the securities of one or more specific companies. Each company can be characterized as belonging to an industry. That means whether you are going to investing in a startups, or whether you are going to invest in a well recognized company, or the company which have already gained a market in the recognition, right? Or in that way you are going to analyze. In binary stage, what happens, where you are introducing a new product and technology takes place. In binary stage, your product is not recognized by the people and they are unaware of it. In case of expansion, there is a slight increase in your sales and gains market before attracting, and it is a best stage for attracting the investments when your product get recognized or when you are making a sales. That means when you are increasing your investments or when you are increasing your sales or avenues of investment. So now investors start get attracted towards your company. Maturity stage, the company is well developed now. So now what happens, the company here, what happens in case of maturity stage, the company loses its power to expand. They will not expand. In the area they have situated, what they have surrounded the market, they only focus on that and they never try to expand. What happens in case of decay? Because it occurs only when there is no demand, because when you don't have any demand, they fail to exist and they completely ruled out of the market, right? Now coming linking this concept to the investment part is the most challenging one. What happens in binary stage? It is investment is very risky. So being an investor, introducing in a new startup is a very risky, because what happens, you are completely unaware about the company and the background of the company, right? This stage has an appeal for speculators. That means those who are very much ready to take the risk. For them, this is the best stage. Next, in case of expansion stage, what happens? Attractive for investments. When you get recognition, what happens? So ultimately people start investing in your company. So ultimately there will be a little amount of investments here when compared to binary stage. Now coming to stagnation stage, what happens? Moderate investment, right? Moderate investments. You will be in a very high level, your investments will be very moderate, and you will try to hold more investments rather than going it off, letting it off. You try to grab more investments. So on the contrary, what happens in case of decay stage? Dispose of investments. That means the investments gradually come down and they get out of it. That means they withdraw the investment from your company. So this is how the being an investor he analyzes. That means in binary stage he is not ready to take the risk, but the investment, making an investment is very risky in case of binary stage. So in case of expansion stage, what happens? You attract the investments once you get the recognition. In case of stagnation stage, what happens? It is recognized by each and everyone in the market and you gain moderate investment and you try to dispose of the holdings. That means you are not letting off the investments, you are gathering more investments. And in case of decay stage, what happens? The investments slightly dispose of and they get out of the market. It's coming to the characteristics of industries, right? Being an industry analysis, when you are going to do industry analysis, these are the characteristics which you want to focus on. First and foremost thing is demand and supply gap. That means you need to have balance between demand for investments and supply for investments. Then competitive conditions in the industry. That means whether the other firms are engaged, how they are going to present their investments, how they are going to attract the investments. So that plays a very prominent role. Next, labor conditions. Next, attitude of the government, then supply of raw materials and cost structure. So these are the various factors which plays a very prominent role in case of industry analysis. Next, company analysis. So while doing company analysis, you mainly focus on pestle analysis. That means companies political, economical, social, technological and environmental factor, and companies SWOT analysis. Strength, weakness, opportunity, threat, focus, culture, all these things are analyzed. I think in the sources of information I have said, right, whenever an investor is going to invest in company, he analyzes income statement, balance sheet and cash flow statement. Same points will be repeated here. So whenever an investor is going to invest in the company, he analyzes these basic three components, and along with it he also analyzes the company's strength, weakness, opportunity and threat, and its pestle factors also. Coming to technical analysis. So technical analysis is quite opposite to fundamental analysis. That means here what you identify is, here by having a statistical data you are going to identify the movement of the price from its volume gradually over a period of time. So from historical prices you take the historical base and then you predict the prices. That means how how the share prices will go, how it drastically moves from upward or downward. That's why it is called as technical analysis. So here it is propagated by Dove theory. Minor trend, that these lower triangled values, that means where it comes gradually slopewards, that is phase 2 or phase 3. That is what the minor trend is all about. Okay, now Japanese candlestick. So very important from your point of view of examination, students. So Japanese candlestick, okay, it was propagated by Sokyo Homa. So what he did was he mainly analyzed the market, how they are going to predict, how you can identify the bullish market or bearish market, how you can identify the prices of the prices of the shares. Okay, how they are going, and they are represented in a candle. So that's why rectangular you can see in the pic, right? It is presented in the rectangular way. That means how, whether you are having high profits or high loss, or you are having opening price is high or closing price is high. In this way you are going to predict the things. So you can see what happens in case of bullish. So what happens in case of bullish candle? See here, the opening price will be very low and the closing price is very high. That means you are having a bullish, that means you are going to predict the high things, bullish market. That means you are where the prices are very high. So on the contrary, bearish candle is that one whose opening prices are high and the closing prices are very low. That means who predicts the prices of the share will go gradually down. So these are the bullish and bearish things, bearish candle and bullish candle. Okay, so what happens in case of bullish candle? The closing prices are higher than the opening. That means when the closing prices are higher than the opening, that means you are having a bullish day. That means you are making a huge profits. On the contrary, when you will be having the bearish day, that means when the closing prices are lesser than the opening price. Okay, that means when the closing prices are lower than the opening price, then you have a bearish candle or bearish day, we can say that. Thank you. If you have any doubts, you can ask me in the comment section, students.